All right, well, I have good news and bad news. The good news is I only have a little bit of time to speak. And the bad news is I have a lot to say. I'm what they call the details guy. Do I have to really use that?
No.
Okay, good. As a result, what I'm going to do is give you a little bit more details to the extent that I can get through without spreading germs and coughing all the time. In any case, this project was born out of our discussions with businesses on the other work we're doing in the business enabling environment on construction permits and inspections, et cetera. And we found out that businesses have a really great need. It's no secret, but the sentiment and the need is so great, we realized that we should probably take a much closer look at this. And this is not unusual for situations around the world where access to finance is one of those typical development problems that are very difficult to assess and very difficult to come up with workable solutions, in part because there are so many pieces to the equation. And so we took a bit of a comprehensive look, probably one of the most comprehensive looks that has ever been done. I like to think so, at least I tell people that. To try to take a look at things across the supply and demand side. So first, a lot of this has already been mentioned. We have 60% not borrowing. That means only 40% are borrowing. And those that are borrowing are not necessarily happy about it. They're doing it under circumstances that put a lot of stress on the business, not ideal for investment, et cetera. So our focus today is both on not only those that are not borrowing, and some should not be borrowing because they're not healthy enough to borrow. And we can't blame the banks or the central bank, as Mr. Senich has mentioned, about the fact that they're not borrowing. But there are some of that 60% who should and can be able to take credit, and that's the types of businesses we're looking to deal with. In addition to the other 40%, we want them to better utilize their finance. But we do have a very negative situation with about 4 or 5 SMEs having difficulty in getting finance or no wish to use formal sources. And that no wish means, well, maybe we don't have a need, but also it may mean that it's just not interesting for us because it's not suitable for us. And I think there's a lot of businesses out there that fall into that category. Of course, the distribution is skewed towards larger SMEs, the companies with more than one, that should be more than 1 billion in revenue, make up about 50%, over 50% of the borrowing. So the other 92%, the smaller companies, but not insignificant companies, the ones that offer the greatest job potential, et cetera, take up for actually it's about 48% of total debt finance. And that's not just 48% of borrowing, it's also finance that revolves on owner loans, et cetera. Amounts are small, 75% of the loans are less than 50,000 euros. Key sectors are underserved. For 50 to 60% of SMEs that borrow, but they actually account for 30% or less of the total debt finance that's being used. Now these are estimates, and there's a lot of estimates in this report, but they're backed by either surveys or other information sources that we're going to talk to you a little bit about in a second. But, oh, sorry, I got to synchronize Serbian with the English. When we talk about access, we really had to have a proper definition. Otherwise, it goes all over the map in terms of what we're trying to assess. And access is pretty much about having healthy SMEs have access to formal lenders that are able and willing to offer affordable and suitable, formal lenders that are able to offer affordable and suitable financing. And there are pretty much 4 key elements to that. The most obvious is physical access. Can I even get to the bank? Does it cost me a lot to get there? Operating hours, etc. We don't have a problem in Serbia with physical access, for the most part. Some regions, yes, but by and large, there are a lot of banks, there are a lot of branches. Availability of finance is not just about the physical availability, it's actually about having the funds to be able to lend, having the right funds to be able to lend, the willingness of lenders to lend, and the reason that they don't lend has a very good reason to it many times, as well as other factors. And affordability, of course, is a key factor, but we're talking about affordability from both the banks, or from the lender's point of view, as well as from the borrower's point of view. And that's not only about the cost of finance, it's also about the level of risk that I have to take to borrow or to lend, because risk implies cost. And the greater the risk, the greater the cost for the lender, the greater the risk, the lower the needed cost for the borrower. And of course, the suitability. I'm taking short-term loans to finance long-term investments is not a good or a sustainable strategy. So suitability of products to the needs of SMEs, in different sectors is very, very important. It affects demand. It also affects the supply issues that we'll talk about. And where do we get information? Well, let's say that there are opportunities to increase the amount of information on this topic, and I think probably there's no one in this room who's not aware of a lot of the issues that credit access to problems raise. But what we took is, rather than take a look at a single source of information, we used a combination of interacting with businesses, getting feedback from them, as well as data analysis, legal research, etc. We did 7 roundtables around the country in all of the major regions with probably about 200 to 300 businesses in total, given their feedback on access to finance issues. We challenged them with some questions. We want to understand how they see the picture and what challenges that they're facing. The survey is part of the national survey that we do of between 900 and 1,000 businesses, where we have specific questions on access to finance in that time. And that's what we call the National Business Survey. And we have have done some specific analysis on access to finance based on the responses. We did a lot of interviews with market participants, one-on-one interviews with lenders, professional services organizations, as well as businesses. We did a lot of looking at business data. Now, we know that what the businesses report on their balance sheet may not always be the most correct figures, but we were honored to have access to the business registry data, the entire database of everything. So we did a lot of detailed analysis of the income statement and balance sheets of all businesses that fall into the category of SMEs and compared them. We did also some separate technical studies of the legal environment for credit, of the agricultural financing environment, and of the environment for supporting services, which is appraisal services, accounting, information services, all of the infrastructure that goes in to helping to reduce the costs of lending for lenders. And we did a lot of document review, both on an international level as well as on a local level. And so 10 main areas of this study were reviewed on both the supply side, but as well as on the enterprise and demand side. Those areas are the legal infrastructure, the laws and regulations that we have in place, the financial regulations, those that are imposed on banks and other lenders, all the products and services, the structure of the financial sector, its depth, its reach, supporting services, as I had mentioned, and some review of state support, notwithstanding that information collection is difficult. And on the demand side, we took a look at SMEs, listening to them, challenging them with questions to get an idea of what their financial capacity is, and as well as what their technical capacity is to meet the requirements of lenders. And then we tried to talk about attitudes and expectations that influence demand, that influence the environment for finance. And then finally, we took a look at the market structure of SMEs and maybe what are some of the issues with how the SMEs are organized. And we took a look at all of those. We had specific standards and things that we used to assess those areas. Not complete in any way, simply because to do a deep analysis requires the cost of getting information that makes it almost prohibitive to do. But we think between the surveys, talking to businesses, and a lot of reviews of documents and situations and data, that bringing it all together, we took the things that looked to be the most significant. And then we also vetted those results with certain professionals to say, are we reasonable or not? Is there anything wrong here? So, but we still stand today able to, I'm so sorry, sorry about that, identify improvements to this work as well as new issues that need to be addressed. And our door is open for that. And we really encourage that. So, and we do encourage to be challenged on this work as well. That's how we learn, and that's how we can give good advice. Each of those areas were evaluated in sort of 4 different types of metrics, which really have a bearing on finance. First is risk. Risk is not only the ability to get the loan back, it's also the level of information I have to determine whether I should make the loan or not. And then it's also my ability to manage it. I can take risk, and if I can manage it really well, or if the regulator allows me to manage it very well, I can take risk. If I cannot manage it, or the regulator doesn't allow me to manage it, then I'm not going to take it. Obviously, I can't. So risk has different dimensions, and it's not just about the risk of the lender, it's also the risk to the borrower. And the borrower is when I take a loan, what consequences do I have if I get into problems with that loan? And that is a significant factor on the mentality of borrowing. Knowledge gaps, information about both sides of the supply and demand. Does everybody understand how the other party, what the other party's expectations and needs are? Do they have the right technical understanding? Do we understand the SME market well enough? And then finally, the big gaping hole is market failures. Even if we had no risks, good costs, and a lot of good knowledge out there, would the market still fail for other reasons? And the answer would be, well, of course, it probably will, because the market is still evolving. And that is where, for example, state support can be very useful. So that's the framework for the analysis. And in the big picture, the constraints that we have up here are probably most people in the room is not going to be a surprise. They've been mentioned in the press. They've been mentioned in different conferences. This is not the first time that we have done this work. Mentioned many times. But what we wanted to do in this study is try to bring it all together in one body of work so that we can then focus on specific solutions to it. Because inefficient credit enforcement, high costs of financing, poor product suitability, few alternatives to getting finance, weak supporting services, limited effectiveness of of state funds, necessary but sometimes limited effectiveness, all have an important reason for why they're there. It's how do you fix it? Same thing on the enterprise side, although the solutions are a little bit more strategic or support-oriented, because obviously providing support to enterprises is something that the government should be limited in doing, and so it requires the private sector to address some of its own needs. But we do have weakened financial capacity of businesses to get finance. We have some negative attitudes and negative sentiment out there that affect demand. We have a weak capacity to represent the business to lenders for different reasons. And we also have weak SME market leverage. The SMEs, as it was mentioned by our ambassador, is very, very fragmented. They're very local, and they don't have that national leverage. They don't have that negotiating position that they could to get better deals, as well as to be more useful to lenders, because when they come in a group or when they're organized, you've got a ready-made body of clients. So if we take those, what we wanted to do is we've broken it down into very specific constraints. How much time do I have? Where am I on the time frame? Am I okay? 15 minutes? 15 minutes. 5 minutes? That's impossible.
Okay.
10 minutes.
Fast.
Even that's impossible. So I'm going to be very, very quick. But I think some of this is important, and this is why it underscores the need to read this study, because there's a lot of details in this study, and there's a lot of, it's a roadmap of what needs to be fixed. But in the weak enforcement area, we have weak court processes. We have a new law on credit enforcement that needs to be accelerated, and the government has begun to do that. They've started to recruit those enforcement officers, but it has taken some time, and so now is the time to accelerate the recruitment of those enforcement officers, accelerate the training, and to deal with some of the inconsistencies in the implementation of that law. I should mention that Serbia has some of the best credit laws and bankruptcy laws in the region, if not generally in the world. It's not the legal problem, it's the implementation of those laws and getting those laws properly enforced. And okay, we recommend issues where there are some tweaks to the law to make them more usable for lenders. However, the general infrastructure for that rate is very good. It's just about getting them to work right for lenders and borrowers. So weak core processes, there are inconsistencies in the interpretations. There's basically the courts need a little bit of help to deal with credit matters in order to get the law to work. Challenges with pledges, movable property, trying to be able to repossess that collateral, there are large problems. Collateral disappears. There are problems with potential loopholes in the law regarding, with all due respect, marital property that enables people to avoid foreclosure on certain properties. The notice process for taking an action on a pledge is not perfect. It needs to be made a bit more simpler for lenders. As well as the pledge law, or perhaps another law could be developed that allows for what we would call floating charges or enterprise-wide charges that allow the entire business to be posted as a security for loan that allows cash flow-based lending a little bit more viable, and other forms of lending to get away from the mortgage collateral business. We also have challenges with mortgage where the mortgage process is not working the way it should be working, and these are really pretty much just technical difficulties with junior liens, with the way that the auctions are run, with some cadastre issues, etc. But the problem is that these are small issues, but they have an effect on the perception of lending, and effectively they have a bearing on the willingness of lenders to lend. We also have we have high costs, of course, but we have externalities, high government borrowing, but we also have, and risk in the European Union. The other issues we have, though, there are some regulatory costs. Some of the regulatory burdens increase transaction costs that find their way through loans. A loan can be increased by 3 to 5 percentage points simply in dealing with all of the processing and documentation costs to get the loan. Some of those requirements are the banks. Some of those requirements are likely regulatory requirements that may not need to be in place given the risk that a lender has to any specific loan. We also have problems with economies of scale. Small business lending requires a different type of business model. It requires a different types of delivery mechanisms to deal with the fact that we're making small loans to a very large number of borrowers. And those economies of scale are not in the market. We have issues. I'm not going to say that the impact of financial regulation is the major issue. The banks and other lenders may argue that it is a major factor, and that's something for us to take a look at. However, we do believe that there are structures in the issues in the regulations that have perhaps a negative bias to SMEs. Those are the way that provisions, minimum provisions being set on payment status. Well, SMEs are mostly collateralized loans, and payment status is not the best way of setting loan provisions. It should be based on risk, and the banks actually should have their own procedures on a case-by-case for determining those provisions. Also, credit file regulations may be too onerous for small business lending, and a lot of businesses complained about that. In fact, we also got input from institutions as well. And there are other factors. For example, we would recommend actually that banks not be required to do things like tax compliance or tax monitoring. We think it breaks down the nature of what a bank should be doing as opposed to the trust it needs to have. And there are other factors that we outline in the report. Poor product suitability. Well, obviously we have situations where we've got a lot of banks, but most of the products are fairly generic. A lot of the products are not particularly specialized for a sector, and as well as this traditional corporate lending approach that goes on, even for the smallest number of loans. It increases cost. It's a bummer for businesses that they have to go through some of these processes. And so it has something to do, we think, with the structure of the banking sector. And we encourage the government to take a look at that sector and try to work with the institutions to try to figure out how do we get a better delivery of the credit. The funding structure, everyone knows, is a problem. We have lots of short-term foreign currency-based deposits. It's very difficult to lend long-term dinar in that situation. 1% of the deposit structure is suitable for lending in long-term dinar. We have poor risk intermediation. I cannot manage interest rate risk. I cannot manage a foreign exchange risk very well, even as a financial institution. I have to push that risk down to businesses who are the least able to manage that risk. They have to absorb it, and they have no routes to manage that risk. So we have some recommendations to address that area as well. And then finally, we have generally weak knowledge of the SME sector. We find that institutions don't know enough about this sector, and there probably could be a benefit of some additional looks at it. Lack of alternative sources. Having a bank-centric system is absolutely fine, and there's nothing wrong with that. The question is it going to be able to deliver all of the credit that businesses need? And we don't answer that question. We can't. That's a policy question. And so we really do think that perhaps non-bank institutions have a role to play, that more regulations for those institutions will allow entry of investment. That also should be good for banks, because non-bank institutions around the world are nice clients for banks. They have two effects. First, they help to cultivate smaller businesses that become clients of banks. They also are actually become clients of banks themselves because they do wholesale borrowing. And the dynamics of the non-bank sector versus the banking sector are very key to the market development, and we encourage the government to take a look at that as well. Of course, we have a thin capital market where for larger enterprises, raising debt and equity would be important. And also what we have is underdeveloped value chains or interfirm financing mechanisms that could be very, very useful for export supply chains and export production. And then finally, the undeveloped supporting services. Appraisal services are not perfect. There are recommendations there. We have a fragmented accounting industry, and there are recommendations there. And we have also recommendations for improving the availability of information, in particular the use of credit reporting. We know credit reporting is well used, well regarded. It's a fantastic organization in terms of being able to get basic credit reports. But there are new opportunities with that infrastructure that could be used to improve credit. There you go. Okay, let me get through these, and then I'll skip the other stuff. On the demand side, weakened financial capacity through liquidity, but as well as inadequate collateral. And there's a lot of issues regarding inadequate collateral. For example, in terms of how businesses manage their collateral to borrower, permitting problems, and things of that nature. Borrower risk and attitudes, sentiment was very, very negative. And we could tell from discussions with businesses that the sentiment does not need to be as negative as it is, but it's fueled by misperceptions, misunderstanding about what banks are all about, what drives their business, and how businesses need to respond. However, it goes the other way. Banks are not reaching out to the smaller businesses at the level that's necessary to understand what they need. And so bridging that gap will be very, very important. The other issue here is in a crisis, the other issue here is that given that businesses have to put a lot of personal assets up, we have a low tolerance for risk. If I'm a small businessman, I don't borrow to take advantage of an opportunity if the result of not being successful with that borrowing has an effect on my life and my security. It's that trade-off. The trade-offs for small businesses are not the same as for large companies. And those trade-offs need to be factored into the types of products that are available. We also have a very high expectation of state support. State support has a very important role to play in this market. However, partly lack of transparency, lack of understanding about what the role of the state should be through these funds fuels expectations. Many businesses hold off borrowing decisions because of expectations that the government's going to create a new program. Or they won't borrow because the government is offering 3% over here. Why should I pay 15% over here? But they don't reconcile why. They don't reconcile, well, this needs to be subsidized. It's a different thing that you're borrowing for over here at 15%. But that type of stuff needs to be communicated to them better so that they at least understand that the government is working in their interests, that it's not just it may be in fact that way, but in fact the government is, we believe the government is looking forward to try to deal with these issues, and information is part of the gap of getting a good response from businesses. As I said, a lot of negative sentiment about banks, and also there's generally a weak credit culture. And that credit culture is a cloud in the sky. It's very difficult to deal with. But it can be dealt with public education, with the government being the exemplar, the representative of good payment, as well as by proper enforcement of contracts. If you bring these things together, you can change the mentality of paying back bills. I'm still trying to get my security deposit back on the first flat that I rented here. And I'm about to use the loophole in the mortgage law, which shouldn't be there, in order to try to give some leverage. But in any case, the credit culture is a factor. We have a lot of information asymmetry. Businesses obviously don't have the capacity to do financial reports and reporting that banks need. We need a good infrastructure for that. The informal economy is a factor. It's very difficult if I operate even partially in the informal economy to show a bank that I'm a good borrower when I can't present my business right. Equally, I can't get out of the informal economy without finance to grow my business. So that catch-22, that dual problem, is something that really has to be addressed in policy measures. We have some recommendations for that, but more needs to be done. And also, of course, businesses like to commingle their finances between personal and business, and that makes it very difficult to lend against when my finances are all mixed up. And finally, on the leverage point of view, really, the weak national advocacy for small businesses on access to finance issues is an issue. I think if there had been stronger national advocacy, we wouldn't be standing here talking about these issues, because I think everybody knows what these issues are. The question is bringing them together and coming up with solutions for them. And finally, on negotiating position is that there's lots of different types of solutions that have been employed around the world for SMEs to improve their negotiating position through their trade links, through industry associations. And we offer some of those in the report, but there's a lot more to consider. I'm going to skip the state financing support and move to the last slide. Last two slides. These are just recommendations. They're in the report. Thank goodness you didn't have me go through all these. Last two slides. This is fundamental, is what are the next steps? Well, we think that priorities need to be set. There's a lot of recommendations, and there are a lot of things that have different weights. Government needs to set priorities. The next step is, what did I put as the next step? Was, if my Serbian were better, I'd be able to read it. Yes, a government-wide commitment. Because there are different institutions and parts of the government involved in these solutions, they have to be integrated. You cannot fix one area, because the problems then just move to the other area, and it involves the Ministry of Justice. It certainly involves the Ministry of Finance and of Economy certainly as a policymaker and as a leader of these reforms, but it also involves the central bank. It also involves several other organizations working together to try to come together to deal with some of these reforms. Private and financial sector need to step up to the plate, somehow organize the South, work through the Bankers Association. We're hoping the Bankers Association will step up and have a separate initiative for some of these issues. We encourage that, but in any case, the private sector and the financial sector need to step up and offer what are they going to do. Business sector can be represented by the regional development organizations as well as the business associations. And then have an integrated plan. What are we going to do? Obviously, it's key. With who's going to do what, and let's see if we can get something working. And then you need a platform for public-private feedback. We have to have this public-private dynamic working all the time, because I think as certain fixes are made, the private sector has to say, yes, this works, or no, this doesn't work, and why, and then reform the plan. And then finally, you got to tell businesses about the progress. Folks in Belgrade may know, but folks in Novi Pazar, in other parts of the country, don't know. I got to tell you, the small businesses, and they sit there, there are a lot of smart people out there, don't get me wrong, and a lot of businesses had a very good understanding. However, they only see part of the picture. And then the rest of the picture they fill in by suspicion, by information they get from unreliable sources. And it basically, no one has the same picture of the problems. So if the government can communicate with businesses, it would be better. And then finally, I leave you with these parting words. And that is there's a lot of benefits to Serbia in these reforms. And we can see this by looking at the growth of industrialized countries for at least the last half decade since World War II. And there may not be any, we don't know of any, major industrialized exporting country that hasn't developed fundamentally on the back of small and medium-sized enterprises. Yeah? You can go to any country. And in fact, what we're looking at right now are countries in Southeast Asia, countries in Latin America, countries in other parts of Central and Eastern Europe, and hopefully other parts of the Balkans that are supporting these SMEs because simply they are the dynamic agents of change. I leave you with that. Thanks for your attention. Appreciate it.